Russell 2000 reached an overbought reading that of 4.42 standard deviations above the 50-day moving average. This is the most extreme reading ever for any U.S. stock market index, including the S&P 500, Dow Jones, NASDAQ, and Russell 2000. What we mean by overbought is how quickly and how extreme something has moved relative to its trending 50-day moving average. Hello, everybody. This is John Lodra. I'm a co-founder and partner here at New Harbor Financial Group. Thank you for being with me this week. The purpose of these videos we put out every week are to bring some data and insight, and really what we want to help our clients and viewers be more at ease with what's going on in the financial world. Got a pretty crazy world out there right now, and certainly the financial markets are no exception to that. It's been a historic week in financial markets, and I say that without over-exaggerating. We have some things that have happened in financial markets, and I'll get into them in a moment, that we haven't seen ever before, frankly. They are extremes that we haven't seen, and it doesn't appear that on the surface, looking at the headlines of many financial news reports, but I'll get into some of that. Some economic stuff is underneath the surface of driving some of these changes. I really want to thank you for being here. Please subscribe to our channel here. It's the best way to kind of get alerted when we put out new content, which we hope is informative and useful. Please provide your feedback and comments to the comment section of this video. Always looking for ways to make these more useful and applicable to what's on your minds and of our clients and viewers. So here we are. It's Friday, July 19th. 2024. The main news headlines are all about politics here in the U.S. We've had some dramatic events, to put it lightly, and I'm not going to rehash those here. Everybody knows what I'm talking about, and crazy is a good word. But aside from that, we've had some really dramatic things happen in markets. And I'll be honest, the things that are happening in markets aren't, in our opinion, my opinion, really directly related to what's going on in the political world. Markets have had their own set of issues boiling beneath the surface that I think have a lot to do with what is going on in markets, irrespective of what's going on in the political landscape. The big news of the last week has been a truly historic rotation from within the stock market. Much of this year, we've talked about how narrow this market has been, very narrowly focused on stocks like NVIDIA, the so-called Mag 7 stocks, seeing outsized gains, and really the rest of the market not really seeing much of that at all. In fact, over recent weeks, we've talked about how we've actually seen the so-called breadth of the market become very significantly worse, and actually to concerning levels. And that was, to us, raising some very important warning signs that, historically speaking, would be well heeded. What happened this week is we saw a truly historic move from large cap, mostly large cap tech stocks into smaller and mid-sized stocks. And I'll show you some data here. And in so doing, some of these breadth indicators that we have seen slowly but steadily erode in a not a healthy way, almost in a matter of a day or two, flipped completely around, which on the surface is a healthy thing. These indicators do speak to broadening participation, but the speed at which they happened has us quite frankly concerned. So this is a graphic that was put together by Jim Bianco. He's a great analyst, and I certainly want to give him all due credit here. What this shows is it shows the 5-day, for rolling 5-day periods, the difference in returns between the Russell 2000 small and mid cap index versus the Russell 1000, which is a large cap index. The small cap index has been a tremendous laggard relative to large caps for much of this year. What you see here, though, the 5-day period ending July 16th, there was a 9.55% outperformance of the Russell 2000 compared to the Russell 1000. You can see this chart goes back all the way to 1978, and there's only a handful of instances where this degree of outperformance has even come close. And in fact, this is the biggest degree of outperformance. So truly historic. It's something like a 6 sigma standard deviation event, meaning this shouldn't happen hardly ever, if ever. Very rare occurrence. What happened, this happened so quickly that the Russell 2000 reached an overbought reading that of 4.42 standard deviations above the 50-day moving average. This is the most extreme reading ever for any U.S. stock market index, including the S&P 500, Dow Jones, NASDAQ, and Russell 2000. What we mean by overbought is how quickly and how extreme something has moved relative to its trending 50-day moving average. All else being equal, when things get really, really overbought like this, they tend to snap back, much like a stretched rubber band, a rubber band that has stretched too far in one direction. Very, very extreme. Again, never before seen. So truly historic. We think it was long overdue, but the degree and the speed at which this happened in its own way is we think, unhealthy. This is an interesting chart that the folks at NASDAQ Dorsey Wright pulled together, and it shows the rolling 6 months performance spread between the Russell 2000 and the NASDAQ. Okay, so different indices, but the same kind of thing, because the NASDAQ has really been the strong performer of the large cap tech stocks over the past much of this year. Each one of these red dots shows an instance where the spread, the difference in performance differential between the Russell 2000 and the NASDAQ was 5% or more. You can see going back to 1993, there's only a handful of these instances, including the one we just saw. What this shows the subsequent relative performance has been. So for example, here back in 2000, what you saw is that very quickly the relative outperformance of the Russell versus the NASDAQs, very, very much the degree declined rather quickly. Long and short is we can't know for sure whether this rotation is a durable one, whether it's a flash in the pan or a durable one. We think it's going to be durable, but we think in the very near term, and we've already started to see it, this is going to be reversed in the near term. But we think it's the first shot over the bow, so to speak, that we're going to see more parts of the market start to carry the market than just these large cap tech stocks. A quick note, I mentioned the speed and the degree to which this rotation happened more or less all at once, we think is an unhealthy thing. In fact, much of this move, we believe, is likely due to very large institutional trades, not a healthy kind of nuanced rotation into more selective parts of the market. For example, if we looked at hedge fund positioning going into this change, if you will, hedge funds were quite long, net long, these large mega cap tech stocks, and they were very heavily short the Russell 2000. So when this kind of rotation started to happen, we believe it created a daisy chain effect of sorts that caused big institutions to have to cover shorts and massive amounts of momentum trading that we think is very short-term in nature as this repositioning has had to get settled out. Participation across the Russell 2000, it wasn't just one sector within the Russell 2000. Every sector, every economic sector of the Russell 2000 posted positive performance during that episode, this recent 5-day episode of relative outperformance. Some sectors did better than others. For example, financials and biotech and things like that did somewhat better than others, but every sector was positive, and the standard deviation, the variation of the performance of each sector was rather narrow relative to history. So this speaks everything to a brute force kind of massive rotational program, we think largely among institutional traders. And already in the days that have ensued, we've seen a bit of a pullback. So this is a chart of the Russell 2000 as measured by the ETF IWM. This is a weekly chart. You can see here, I've got this triangle drawn here. This is a very powerful breakout. This is week 1, week 2, the last couple of weeks. Very powerful breakout. Now, what you see here is this peak, that line. We've had a massive pullback from the peak of Tuesday this week. And if I go to a daily chart, you can see that better. So we've had a really sharp pullback. We got very extremely overbought, and we've seen a pullback. I think it's quite likely we do pull back more, but I think this is the first shot over our bow where we're going to see a more durable rotation of market exposure from the large cap tech stocks into a broader swath of the market. So remains to be seen, but that's what the evidence speaks to us. Now, one of the I mentioned that we don't think this had a lot to do with the politics going on in markets, but one of the things that has happened is interest rate messaging from the Federal Reserve and the market's expectation for interest rate cuts has really did a dramatic move recently. Chair Powell of the Federal Reserve had a decidedly more dovish a month or two ago. He was talking down, hey, we're not seeing the durable evidence that inflation has pulled back to our 2% target, so it's premature to talk about cuts. We're not sure when we're going to cut, so very hawkish. More recently, in the last couple of weeks, he testified in front of Congress, I think last week, much more dovish. It was rah-rah. We were very encouraged by the progress we've made at getting inflation back to our 2% target. And he also referred to other things that they need to be worried about. And a lot of folks are reading into that. And in fact, had the privilege of being able to hear former Fed Governor Dr. Thomas Honig give an interview with Adam Taggart the other night. The bottom line is Dr. Honig thinks that the Fed is becoming increasingly concerned about the job market, and that's really maybe what has spooked them into. And in fact, we have had some deterioration in the job market of late. I'll show some slides later to speak to that. The result is a very dramatic repricing of the market odds for rate cuts. This is a graph that goes back a year, and it basically shows the market's implied probability of the federal fund interest rate range staying at the current range, which is 5.25 to 5.5. This is the target range that is set by the Federal Reserve. This is what we all obsess about every time they meet. Are they going to drop rates, keep them the same, or raise them, or whatnot? We've been at 5.25 to 5.5 since July of 23. A year now. And here's what happened in the last couple of weeks. We went from about 20, I'm eyeballing this, maybe a 26, 27% market implied probability at the September meeting, by the September meeting, the Fed keeping rates at the current level, to essentially zero. In fact, 2 days ago, the market literally placed 0% probability on it. I don't know, with all humility, there's not too much in life that I'm 100% positive about, but the market seemed to now the odds are something like 98% that the Fed will drop at the July meeting. But the point being is dramatic change. Okay, and all else being equal, these small caps, the Russell 2000, are much more interest rate sensitive than large caps, because a lot of them don't have the means to secure long-term fixed rate financing like larger companies do. So the sensitivity to their financials of interest rates is quite extreme. So that, we think, was a catalyst to start this stampede into smaller caps. I do want to talk a little bit about the historical accuracy of market expectations. This chart shows the black line is the actual federal funds rate, and these squiggled lines are the historic market expectations for what those rates would be. What you see here, all these squiggles that deviate quite dramatically from the black line, these are all evidence or instances where the market got it wrong. So as much as the market has priced in near certainty, I do want to inject a tone of humility that the market can oftentimes get this wrong. I do believe the odds have greatly increased that the Fed is getting closer to dropping rates, but I would caution that it's not a certain thing. And many assets have priced this in as if it's a certain thing. And I might even suggest that the stampede into small caps, the Russell 2000, maybe is getting a little ahead of itself. As I mentioned, Dr. Honig in the talk with Adam Taggart the other night talked about the job market. And we have seen some softening of job reports recently. And that's something that I think is a wild card. If we do see an acceleration of deterioration in the job market, that is something that we think could cause the Fed to act sooner than later. And add on top of that, if there's a financial accident, or certainly if there's financial market or economic turmoil that ends up coming out of this political instability that we now suddenly have before us, the odds of a rate drop certainly can rise and will rise with that. This just came out yesterday. Yeah, in fact, you can see here July 18th. What this shows is a plot of initial jobless claims, the orange line, and continuing jobless claims, the blue bars. You can see both of these are trending higher. Obviously, there's noise. It's going to wig and wag up and down month to month, week to week. But this is a trend that is, certainly in the Fed's eyes, not an encouraging one. They've talked about a very tight labor market as one of the reasons they needed to raise rates and not lower rates. As the labor market begins to soften, the case to drop rates becomes greater, at least in the Fed's minds. This is a chart that looks at unemployment rate, and what we see here is we're starting to see a little hook up here. It's very reminiscent of hooks up before a sudden move higher in the unemployment rate that is a very coincident factor with recessions. The recessions are these gray areas. So too early to say, but there is some credible evidence that the job market is starting to falter. And that certainly is borne out by some other data. This is a plot of temporary health services, temp agencies and companies hiring temp workers. You can see we've had a very steady degradation here. And this chart goes back to the early 90s, but That also, too, is a fairly good coincident indicator of recession. So we do think the odds of a rate drop are starting to increase. Now, interestingly, we now have analyst forecasts for earnings at very strong year-over-year growth. These are not actual earnings, they're analyst projections, very strong. And the market has priced that in. We think somewhat, wishful thinking, to be honest, especially if we see some of the economic deterioration that comes with a rising job market, dislocation or deterioration. So we remain at U.S. stock market valuations that are as extreme as any time in history, and there's only 2 times in history that even rival where we are right now. We have clear evidence of some exhaustion in some of these momentum stocks, these large cap tech stocks that have carried this market higher. We're starting to see economic slowdown. Too early to run for the exits, but we do think it's absolutely imperative to be very defensively minded here. And the areas that what we are doing, we think the market is going to be much more selective. In fact, we have been very tactical in trying to capture some rotations into other sectors. So, for example, we just added a small slice of exposure to the telecommunications sector, which has seen a relative strength breakout. Other areas that we have some exposure: healthcare, financials we added recently. These are all slices of the market that are showing really good relative strength and really good stability, relatively speaking. So we think it's going to be really important to be much more selective going forward than just broad market exposure and heavy exposure to the large cap tech stocks. That's all I want to cover here today. I hope you found this useful. Again, please subscribe and like our video, and we welcome your feedback all the time. Give us a call if you're a viewer and not a client, or certainly if you're a client, give us a call. We always want to talk to you and make this a personal thing. What we communicate in these videos is meant to be for broad digestion and education. Nothing beats a one-to-one personal conversation. So thank you very much. Have a great day, and we'll see you next time.